Good morning and welcome to this Monday, December 20th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've got an abbreviated week this week. Christmas holiday falls on Saturday. The market will be closed in observance of Christmas on Friday. So we just have a 4-day week this week, and it's getting off to a rough start. A lot of headline news on the Omicron variant, and as a result, we do have futures pointing significantly lower at the open. Currently, the Dow Jones Industrial Average, well, as of about 10 minutes ago, Dow Jones futures were down about 435 points. The S&P a little over 60, and the NASDAQ down more than 230 points. So going to get off to a rough start. Crude oil down almost $3 a barrel, back down below $68 a barrel. We got the 10-year Treasury yield dipping just a little bit below 1.4%. It's been an interesting run, watching what's going on in the bond market. I think that one is probably the biggest head scratcher for me. And we're going to get into the charts here in just a minute. But, with all the inflation fears out there, you would want to sell bonds. You wouldn't want to be holding bonds earning 1.4% in an environment where you've got much higher inflation. I mean, all you're doing is just losing purchasing power. So you'd want to get out of bonds. So that should be sending the yields higher, and yet yields aren't going higher. And then the Fed comes out last week and announces 3 rate hikes next year. And I wrote an article. Maybe I can take you back and show you where that article was, but it was back at the end of 2018. I wrote an article when Fed Chair Powell came out back then in the middle of the trade war and said that there was going to be 2 rate hikes. Did it right before the Christmas holiday back in 2018. And I remember writing the article about how the Grinch Stole Christmas, featuring Jay Powell. And I feel like this is a repeat because the bond market is not saying the same thing as the Fed. And so I always listen to the bond market. I'd be very surprised if we see 3 rate hikes in 2022. I'm not sure we're going to see one, but if we see one, that might be about it. I could see maybe in the May, sometime around May, getting a rate hike with inflation, still probably running high at that point. But I think we'll see inflation start to come down. I don't know, just my opinion, but I don't think we're going to see 3 rate hikes in 2022. And I think the bond market's agreeing with me. So that's probably been the biggest head scratcher over the last week or two is, just looking at inflation, the numbers that are coming out, looking at what the Fed had to say, and then looking at what the bond market's doing, which is just not following suit with either one of those other two. So I guess you can make of it what you will. But as far as I'm concerned, I just think I'm going to follow what the bond market's telling me, which is that chances are we're not going to see those kinds of rate hikes. Let's go ahead, and I want to take you first, before we get into today's show, let me take you over to Earnings Beats for those of you that are new. If you scroll down, if you don't know that much about us, just scroll down. We have a free newsletter, no credit card required. Just type in your name, email address, and we will begin sending you our newsletter, which I publish 3 mornings a week, Mondays, Wednesdays, and Fridays, normally out by about 8:30 or so, sometimes a little bit later, but we try to get it out before the market opens. It's just a good way to maybe get a feel for some of the things that we look at in terms of the market. And I think you'll enjoy the newsletter. It's a very quick read, just a couple paragraphs and a chart. So make sure you go to earningsbeats.com and scroll down and check that out. Taking a look at what happened on Friday, you can see the Dow Jones down 532 points, S&P down 48, NASDAQ was down 10. So all of a sudden, the NASDAQ got down to support right here, and it held, while the other 2 major indices were nowhere near support, and they started falling. However, with the NASDAQ where it is this morning with futures, it looks like we're going to gap down below this support level. We'll still be above support on both the Dow, well, especially the Dow. I think the S&P, we're going to be close. Actually, we should be all right, because I think I said it was down about 60. So that would be closer to the 45, 60 area. Should still be above that support level. So we should be all right there. But the NASDAQ is going to be interesting because we are looking to open below recent price support on the NASDAQ. Mid caps also hanging on to support, small caps doing the same. I've been pointing out to our members at Earnings Beats, small caps I've been watching pretty closely to see if this area of support holds from back over the summer months, July, August, September. Really would like to see this area of support hold. Probably going to test it early on today. If not today, probably over the next couple of days. I wouldn't be surprised we get down here. We need to see some buyers coming in. The other thing that bothers me a little bit with the mid caps and small caps, I'm going to talk about the AD lines in a little bit, but look at the AD line moving to a 6-month low on the mid cap, same thing for the small caps. And yet the NASDAQ, even though we're about to break down, the AD line is about to break out. So it seems like these moves to the downside on the NASDAQ are actually being accumulated by Wall Street. And we saw this exact same thing develop back in March of 2020 when the pandemic first hit. This was one of the clues that told me the bull market was not over, that, you know, it was a healthcare crisis, not a financial crisis. That AD line continued to be strong back in 2020, throughout 2020. And so far, we're seeing it hold up pretty well, at least on the NASDAQ right now. But again, we'll talk about that in just a bit. Moving on to the sectors, all 11 sectors down on Friday. And again, I mentioned this recently. I don't know how many times we have seen this now in the last month or so, where we either have all 11 sectors higher or all 11 sectors lower. But it has happened a lot in the past, I'm going to say 5 weeks, maybe 5-6 weeks. Over those, what would that be, 25 to 30 days? I'm guessing we've seen this at least 10 times. I don't know, I have to go back and verify that, but it just seems like it's been a lot. Normally, markets kind of, we don't see these big sell-offs or these big moves to the upside. Normally it's more rotation between, you have 4 groups up, 7 groups down, or one day maybe 8 groups up, 3 groups down. It has just been either a whitewash or everyone's buying. It's been really crazy. And it's, it's back and forth. It's not consistent selling. It's not consistent buying. It's just crazy. And 2021, in my opinion, I'm not going to miss 2021's trading at all. I think it was harder than it was in 2020, to be honest. 2020, I saw some signals, could find where money was rotating into. As we went into 2021, I said at the beginning of the year that the rotation was going to be the difficult part. I felt like the market was going higher, but trying to get the rotation right was going to be the issue. And that has been the issue all year. Trying to figure out whether growth is going to lead, whether it's going to be value, small caps versus large caps, which sectors. We've had different sectors leading throughout different parts of the year. It's just been a nightmare from a rotational standpoint, in my opinion. And that's coming from somebody who likes to trade. So, it's just that whatever you see for a couple of weeks doesn't last, or maybe even a couple of days. I think some of that will start to subside in 2022, but I'm thinking the second half of the year, we'll see less of the crazy rotation. That's just my gut feeling right now, looking at some of the charts. I think the first half of next year could be very similar to what we've been seeing in 2021. Unfortunately, there's just too many uncertainties. The VIX is too high. It remains up in the teens and 20s. Anytime you get that, the market just doesn't handle any kind of bad news well. And then you just get these knee-jerk reactions in both directions. We don't know what the Fed's going to come up with this year. We still got inflation, back and mostly moving higher. But there's a lot of differing views on what inflation is going to present. I think maybe we'll get more clarity as we get into the second half of 2022. So not so great news, because this type of market, I think, is a really difficult one to trade. I would say the advantage definitely goes to buying holders over in 2021. I personally would have done a lot better, probably just to have bought at the beginning of the year and just not done any trading. I haven't gone back and looked, but that probably would have worked out better, just because of the significant rotation that has taken place and the proverbial carpet being pulled out from under your feet multiple times throughout the year. Anyhow, all 11 sectors were down on Friday. Real estate did the best, lost only 0.3%. And that would be consistent with the market being a little nervous about inflation. I would expect real estate to do a little better. But the other groups, financials, energy, staples, industrials, at least it wasn't technology and consumer discretionary. Financials, energy, staples, industrials, that is kind of making me think value. So you've got inflation, a group that typically would do pretty well with inflation leading the way. The value group's not leading the way, and a little bit more rotation back toward growth on Friday, which was comforting after the last few weeks, which has been horrendous for growth stocks. We saw this back in February to May, where it seems like we're in one of those periods again right now, where growth stocks just out of favor. We'll see what happens over the next few weeks. I still think growth stocks present tremendous opportunities going forward, but short term, it's going to be a little dicey, probably going to remain dicey for a while. All right, 10-year Treasury yield. Well, first, let's go through some of the economic reports. So the only one due out today is the November leading indicators. That'll be out later this morning, expecting a rise of 0.8%, which is a slight drop from October, which rose 0.9%. Later this week, Wednesday, we have the third estimate of Q3 GDP. Then we've got consumer confidence and existing home sales. Thursday, initial jobless claims, durable goods, personal income and spending, new home sales, consumer sentiment. So pretty busy week still. And then we'll wrap that up, all the economic news on Thursday. And as I mentioned earlier, Friday will be, the market will be closed in observance of the Christmas holiday. Our schedule, if you are an Earnings Beats member and you didn't see the note that I put in daily market report at the end of last week, we're going to be on a modified schedule. Trading Places Live, I'm going to do that today, obviously, and I'll do it again on Wednesday. The recorded versions of Trading Places Live, which typically airs on Tuesday and Thursday at 9 a.m. at Stock Charts, those shows the rest of this year are going to be evergreen. So, and an evergreen show is just kind of a timeless show. So I don't know which ones they're playing. I've done a few of them, but it might be on market tops. I don't know what they're going to be playing, but I just want you to know Tuesday and Thursday, the next 2 weeks, will be evergreen shows. So they will not be based on the current market action. As far as our schedule at Earnings Beats, this week should be pretty uninterrupted. I can't think of anything. We've updated all the chart lists at this point. Might have one or two I need to try to get updated before the holidays or during the holidays, but this week should be pretty normal. Next week will be more skeletal. That's the week between Christmas and New Year. Most of the folks that work here at Earnings Beats will be taking the week off. So if you're sending any customer service questions in, just expect that it might be a little bit longer. We will be looking at it. We're just not going to be looking at it every, throughout the day. So expect a little delay there. Also, the daily market report, I'm going to be traveling out of town. I will probably do one, maybe two, but they could be at any time of the day. Normally I like to do them in the afternoon after I've seen what's been going on with the market, but they could be any time of the day, and they'll probably be abbreviated. And there'll be no shows next week. So just want to let everybody know things will be, and of course the market's usually much more quiet. Now I will be paying more attention because of what's been going on, the volatility and the selling and the, back and forth. So I'll probably do more than I ordinarily would. And if something, if I see something that's really important, obviously I'll get that out to you. I will be following the market, even though I'll be on vacation and out of town. All right, the 10-year Treasury yield, went through all of those economic reports. I mean, this is what I was talking about, though, here over the last week or so. Got the Fed coming out saying 3 rate hikes in 2022. And, if we look, I'm going to shorten the chart down to a 10-minute 5-day. Let me actually go out a little bit further here. Let's go to about an 8-day. So when was it? It was Wednesday was the announcement, right? So it was right here. So they come out, they announce, okay, 3 more rate hikes or 3 rate hikes in 2022. And you can see the initial reaction in the bond market was, oh my gosh, let's sell bonds. If rates are going up, bond values are going to go down. So you want to get out. So you sell bonds, the yield goes up. That was the initial knee-jerk reaction. Since then, we're seeing the yields going down. So we got this supposedly runaway inflation now. We got 3 rate hikes coming, and everybody's buying bonds. Makes no sense. So that's why, for me, I stay away from the headlines, because the headlines will make you convinced that the market can't possibly handle this news. And yet the bond market's going down. The yield's going down. Bond market itself's being bought. I don't know. It just doesn't feel right to me. And if the yields are coming down, that could be that the market does not believe that we have an inflation problem, and the market does not believe we're going to get 3 rate hikes. And that, if that is correct, should be great for growth stocks. We did see growth stocks bounce back a little bit on Friday, but overall growth stocks have not been going very well. And that's the confusing part. It's like, okay, well, why is it Wall Street taking advantage of folks, seeing the big drop and then, and then accumulating on the drop? Well, that's what the AD line tells me on the QQQ. We'll look at that in just a minute. I don't know. This is going to be a very interesting period. I don't exactly have my finger on the pulse of it just yet. I'm doing a lot of analyzing of numbers over the past few weeks, looking at different sectors, industry groups, trying to find out what the market is, what's the message. And it's still somewhat confusing, in my opinion. All right, so let's move on a little bit. Here's the S&P 500. Now, when I look at the S&P, if I didn't know anything else, and I'm just looking at this chart, I see equal highs coming across and perhaps even rising lows. This could be in, nice ascending triangle. Or maybe it's a move up, left shoulder, neckline, head, right side of the neckline, right shoulder, and we break out of an inverse head and shoulder. Now, based on futures and the fact that we've already gone below the left shoulder, and the fact that usually you don't see the neckline go up above the start of the pattern. Normally, this is the high over here. Then you go into the left shoulder, and your neckline normally is below that prior high. So it doesn't really look like an inverse head and shoulder pattern, but it could be some sort of an ascending triangle, or it could just be sideways consolidation. Maybe we go back to 4,500 and then break out. But I don't really see anything on this chart that is alarming to me. And you might say, well, the volume has been going up on the selling. Well, we saw that back in February and March. I think that's way overblown, because usually panic will create more volume. Panic selling will create more volume than panic buying. We rarely even get panic buying. Buying is, you don't feel forced into it. When things are bad, headlines are bad, the Fed's coming out with their headlines, raising rates. That's what's going to, dictate some of these headlines, and you're going to start to see more fear, and that's going to drive the volume. What's more important to me is, do we lose major support levels? And I would say short term, it's 4,500. Intermediate term, it's 4,300. Those are the 2 levels I think you got to watch on the S&P. The S&P could go all the way down to 4,300, and we still be in an uptrend. Rising, come down, print a low, move to a new high. That would just test the prior low. So 4,300 is kind of like, I don't want to see it go down there, but it could go down there if the market continues to be weak. Let's talk a little bit about these growth stocks, because I've talked already quite a bit about growth. This is the small cap growth versus small cap value. So you can see where we were back at the beginning of the year. And there's that February to May period that I said was so brutal. We're not that bad, but it's been pretty bad. I mean, definitely trending back down. You can see the September to October period had a little rise into the end of October. And now we're trending lower. And last week we hit about a 6-7 month low, growth versus value, small cap. Now, if you come up here and you just change this to mid cap. So now it's mid cap growth versus mid cap value. You see, here's where we were. We came back. I thought we did a little bit better, but now we've started to roll over. And once again, last week went down to about a 6-month low. And then there's the large cap, which is a little different look. Large caps have done better, growth versus value. So here you can see where we were back at the beginning of the year. We're actually higher than we were back then. And you can thank stocks like NVIDIA and AMD and Apple and Microsoft and Google, Tesla, all these companies that have been going up during the year, the large cap growth, that's what's been driving this ratio higher. But even that's been coming down, and we went down to almost a 2-month low last week. So growth is definitely kind of out of favor right now. We'll see whether or not we, see a bid reestablished, maybe before end of the year. I don't know. One thing I will say though, and I've talked about this before, historically, the first month of the calendar quarter and even into the second month are much better for growth versus value. The overall stock market tends to do much better in the first 45 days of a quarter than it does in the last 45 days of a quarter. So right now we're in that last 45 days of the quarter, although historically November 15th to December 31st is actually not a bad period at all. It's pretty strong, to be honest. This year, not so much. 2018, remember with the trade war, was not a good year. Usually it is, though. Now, as we get into January, we're going to start focusing more on first quarter earnings. And who knows what we'll be saying about the Omicron and the inflation and the Fed. I don't know where all that's going to be, but we'll start to look more toward earnings as we get into the beginning of the year. And like I said, as we move into the first month of each calendar quarter, the market historically has performed better. We'll see. All right. One last thing I want to talk about with growth, and especially if you follow our portfolios at Earnings Beats, I mean, we've got a really good long-term track record. 2021 has not been good for the portfolios, and we're basically growth investors. And then, as I was just showing you, especially among small and mid-cap growth, they've been downtrending versus the value stocks throughout most of 2021, and a couple of periods been hit pretty hard. One of the things that I like to look at when I'm looking at our portfolio performance, because we always talk about, the benchmarks, the S&P 500, that's really what we want to beat. But it's really hard to do that every quarter. I mean, let's be honest. For a while, we did it almost every quarter. This year has been not particularly good, especially the February to May quarter, and the current quarter has not been good so far. But again, it's, based somewhat on the themes. If you're not getting money rotating into growth and you're mostly putting together growth portfolios, probably not going to do very well. And that's been the case. But what I wanted to point out was, if you do follow the portfolios, a couple of other charts that I would follow. Number one is the Innovator IBD 50. So this is a growth oriented fund, probably a little bit more large cap oriented than what we do. But still, it's definitely growth. It's momentum and it's growth for the most part. And you can see it was actually doing pretty well into the beginning of November. But look at this drop. We've seen it's down almost 20%. It's almost bear market territory for the Innovator IBD 50 just over the last 6 weeks or so. So it's been a brutal period. The other one that I would watch is Cathie Wood's funds. I personally like to watch the ARKK, which is the Innovation ETF. This is another one. Look at the chart. It's at a 52-week low, or it was last week. So this is just giving you a sense of what's been going on with some of the growth stocks and what I think are some really good growth portfolios. I still really like the ARK funds. Short term, yeah, it's been horrible. I mean, if you've been in them in 2021, you probably think they're the worst managed fund ever. But if you had been in it for the last 2 or 3 years, you probably have a little bit more patience in 2021. It's really all about what you experience. But I think that this is a great long-term investment. If you're into ETFs, and I actually have this in one of my own IRAs. I actually added the ARKK recently because I think it's gotten beaten up. I think next year, I don't know when, but I think next year we're going to have a big rally in growth stocks. I believe we are not going to see those rate hikes. I believe inflation is going to start to come down. And I can tell you this, historically, when the inflation rate starts to come down, growth stocks explode. So I'm just starting to buy into this. If we continue to go down the next few months, I'll probably be adding, because I do believe at some point in 2022, we're going to see growth take off. Might be 6 months from now. I might be next, might be this week. I don't know. It's been a crazy market, but I do like growth going forward. One last stock I'll show you. One stock that's kind of gotten back in favor, and maybe it's the Omicron worries, but here is Zoom video. Last 2 days of last week, I'm going to pull up a 5-day chart. This is a stock that's really struggled, not because it's not making money, not because it's not growing. It's because its growth rate is not what it was, which I have problems. I struggle sometimes with Wall Street, because Zoom will have estimates out there and they'll beat the estimates, and then Wall Street sells the stock saying growth's not strong enough. But they beat estimates. So I would think that's stronger than what was expected, unless Wall Street firms were looking for even more than what Zoom was guiding. And I think that was the case here. And I think that's the case in some of these growth stocks that we're seeing get hit pretty hard right now. And I believe a lot of them are going to bounce back strong. I don't know if this is starting something for Zoom or not, but you can see the volume really picked up again. If we go to a daily chart, you can see that volume really picked up, but it's still got work to do technically. Got to get through the 20-day. Even if it gets through the 20, you've got overhead gap resistance, 50-day. PPO has been negative now for several months. We got to get that positive. There's a lot of work to do on this chart. But I just thought it was interesting the end of last week, as some areas of the market were getting hit pretty hard, Zoom started rebounding. And that'll be interesting to just kind of watch this and see if it continues to progress like that. All right, AD lines. I just wanted to show you a couple of these AD lines real quick. Spider, the AD is still up near its 52-week high. So even though we've had some big selling, we've seen big volume, the AD line's hanging in there. The one that I think is most amazing is the QQQ, where we are back down near about a 7-week low on the QQQ in price. And we just set a new high on the AD line last week. So this is kind of an interesting development. And with futures, it looks like we're going to probably go below the 380 level. We can look that up real quick, see what the QQQ is doing with just a couple minutes to go. Yeah, down 561. So it looks like 379. And go over here. Well, we were down in the 370s last week. Will we put in another hollow candle today, or is it going to be a big sell-off? Your guess is as good as mine. I mean, the market's pretty volatile, and the headline news isn't good. It could be used as an opportunity to accumulate. I'm going to be more interested in how we close rather than how we start. I want to see how the market finishes today. If we finish strong, it's another, hollow candle. That's kind of paints a little bit more of a bullish picture than seeing one of these big red candles, filled candles, where we break down. Completely different look to it on the chart. Earnings spotlight. Just wanted to mention a couple of earnings coming out later this week. Actually, today we have Nike and Micron. So I thought we'd look at both of those, and then we'll do the 3 you must see, and we'll wrap this thing up. So Nike going into its earnings tonight, you can see relative to footwear, it's breaking out to a new 52-week high. So the footwear group would certainly like to see Nike perform well, or to have a good report tonight, because if your leader doesn't report well, it probably doesn't bode well for the rest of the group. So we have Crocs in one of our portfolios. So Crocs, obviously, you're going to be perhaps moving one way or another based on what happens with Nike. The other one is Micron. So Micron, it's been moving up, seeing a little bit of relative strength here. I would probably, if I traded, I would not want to go below the gap support here at about 78.5, 78.75, whatever that open was right there. Big volume, moved up. We've been kind of rolling over. So let's see what happens with earnings. I'd like to see another breakout, maybe a move through 87.50. We'll see. All right. The 3 you must see, I thought I'd take the S&P 500's 3 worst performers from Friday. So let's start off with LEG. LEG, big move down, breakdown. There's the big volume. That's the kind of candle I talk about that does not look good on the chart. See what happened here? Big move down. We saw a little sideways action, then we kept going lower. This one, not only did we see the big move down, but look at the volume. I could not be interested in LEG at this point. All right, then we got Oracle and Western Union. So Oracle, AD line been going down, even though price has been going up. I don't know. This one makes me a little nervous. I think there are better stocks out there, even though we did break out. I just, we've had one hollow candle in the last 7 days. So while price is going up, it doesn't seem like there's a lot of accumulation. And that AD line is telling me the same thing. I mean, just look back here over the last couple of months. Very few hollow candles, more filled candles and failures late in the day. And that makes me a little nervous. And then the last one I'll give you and we'll wrap up. Western Union, breaking back up there, but there's that big red candle coming back down below the moving averages. And now you can see us gapping down again today. Look at the AD line. I'm sure, yeah, the relative strength has not been very good. This is a stock I would just, as a momentum trader, I'm not interested when it's downtrending. I got to see more. I need to see it holding 20-day moving averages, breaking back to new highs. I'd like to see the AD line going up. I'd like to see some relative strength. Not really seeing much of any of that. And so from a momentum standpoint, I'm not going to be interested in a stock like this that keeps spiraling lower. All right, that's it. Again, want to just mention to everybody, we are going into more of a holiday schedule. So the last show that we'll do this year, the last Trading Places live show that I'll be doing is on Wednesday. No more shows after that live until the beginning of the year. Also, I want to mention, we haven't really gotten anything out yet, but we do have our Market Vision 2022 event coming up on Saturday, January 8th. Probably about 4 hours, I'm guessing, something like that. I'm going to get a few folks from over at Stock Charts to join me, and we're going to talk about 2022. I think it'll be a great event. So just mark that on your calendars for Saturday, January 8th. All right, that is it. Let's get a quick summary on how bad the market opened. Dow right now down 503. NASDAQ down 219 on a percentage basis. All of them are down similar. Small caps, mid caps down a little bit more. The VIX is up 20% to 25, almost 26. So here we go again with the VIX up, market down. If we finish weak, I think we probably have more weakness ahead this week. If we can rally off of some of the support levels I talked about earlier, then I think we have a little bit better shot. We'll see what happens. Anyway, everybody have a great day, and I'll see you back here on Wednesday for your next Trading Places Live. Happy trading, everybody.